Good morning and welcome everyone to the Schwab YouTube coaching channel. It's the Thursday edition of Trader Talk in today's market, and I am your host, Kevin Horner. Thank you all for being here this morning. I am joined by my friend Scott Thompson there in the chat. I see lots of activity in the chat already this morning, so glad you are all here with me. Of course, Scott there to get to comments and questions that I am unable to, but I'm going to keep a close eye on what's happening there in the chat nonetheless. You know, on a Thursday, when I'm rolling with you guys solo, we're going to try and get to a number of individual equities for you this morning, and I'm happy to address some if I can find some good stories behind them in the news, that is, then stuff that you guys are looking for as well. If I can match up with the headlines, I'll be happy to do that and try to bring some of your requests to the table. But traditionally we don't respond to specific symbols, but like I said, if I can find good stories behind them, upgrades, downgrades, etc., happy to bring those to the table. So if you're not already doing so, make sure that you're following us all on X, and of course be subscribed to the Schwab channel. We call it Trader Talks. We would appreciate that as well. Now let's get to our disclosures and then we'll move into the charts. So first of all, remember that everything we discuss for you here should be considered informational and educational only. We're not making recommendations here, nor are we endorsing any specific approach to trading the market. We are going to discuss technical analysis as we evaluate these charts of the market, though. In doing so, these concepts and strategies that I'll bring to the table, these are just ideas that some traders choose to work with. Whether you choose to or not will be tied directly to your comfort for trading, familiarity with trading, your risk management techniques, etc. So make sure that you're customizing any of the technical analysis strategies, concepts, ideas that you're choosing to fit your process, your personalized trading scenarios. So that's very important, of course. Now, if you are new to our Trader Talk segment, we follow a top-down methodology where we'll start broadly. We look at indices, the S&P 500, the NASDAQ 100, and the Russell 2000. We also try to expand out of that into a macro-level discussion, which often, of late, incorporates things like the dollar and oil, among others. So we will look at a lot of stuff today to try and get a picture on really why the market's been a little bit choppy of late. So we'll try to kind of provide a little color to that extent as we work through the charts with all of you. So let's get started today with the S&P 500, which is commonly where we get going. You'll notice, everyone, all that we're doing over the last 3 days is pulling back to our breakout spot, at least initially here, right? So what we have seen was the 7620 ledge offering us support, and now we're offering us prior resistance, excuse me. And so now we're thinking, hey, maybe 7620 can be short run support. I will point out that as we have pulled back, one of the shorter term scenarios some of you traders were watching is the 10-day simple moving average. And that's because when we rallied up, we held it here as we built this little flag situation. And then for the last 3 days, now that we closed below it, we've been below it. We've maintained below it. Now remember what this might imply for us. It does not mean that the rally to the upside is over and done. It just means for many traders in that shorter window, 2-week window that is, you're looking at a bit of a pause to the trend. And so should we be surprised to kind of go sideways in here, maybe even see some short-term price action that leads us back to 7620 for a test of support, whether that be horizontal support at that 7620 or our 20-day simple moving average, which is catching up to that level. As you can see today, 7633 on the 20-day now. So we're already through that level, and that gives us a combination of factors to validate 7620 for potential support. So we're going to stay optimistic. We're going to continue to look at the patterns that we see as helpful, right? And what we expect to see isn't necessarily what we're going to see. So what we need to have on our side of things is, how will I take action if something occurs? So for some of you, a close under the 20-day or a close under my white line would be a significant development, and that would be tied to your time frame for being invested. If, however, you said, you know what, I'm not really worried about the 20-day, that's very short term for the way that I like to look at things, then perhaps you're watching more likely a 50-day simple moving average or even a 100-day simple moving average. The 100-day has been a little bit more consistent in the sense that we haven't even tested the 100 period. As you can see, I mean, we're pretty far off from it now, and our recent lows were still pretty far away. So as always, define your time frame first so that you know which trend matters most to you. All right, let's take a peek at our NASDAQ here. NDX doing something similar, except the big takeaway on the NASDAQ as I see it is the hold of our gap level in here happens to be coincident with that 20-day simple moving average right now. So we do have a little bit of confluence there, right? And you can also remind ourselves of the broken downtrend with that gap move up. So we took out the downtrend and have held the gap ledge since. Again, does that mean that the gap or that the trend has to go higher? No, but it does give traders a belief more likely that there's upside than there is downside. And whether that's, a 55-45 proposition of more upside or downside, or maybe 60-40, that remains to be seen. But ultimately, it is now, we would say, as technicians at least, still more likely for upside than for downside. But everything changes on maybe a close under the 20-day or a close that gets you below the high of the gap. And again, I often say it, and those of you who are here frequently hear it all the time. Layer those exits, everybody. There is absolutely no definitive reason to be a seller of everything at one level versus another. You can always say, you know what? If we violated this level, I need to be selling some. And if we violated the next level, I need to be selling some more. So make sure you have that process easily established so that you can refer back to it and make those decisions in the moment. It's the hardest part of being a trader, as I've found, trying to make those decisions if you haven't considered the possibility of what you're witnessing happening. So we say all the time, it's the process we want is to trade what we see. But if we are ill prepared for what we're seeing, well, then suddenly our emotions overtake us. And now we're making decisions based on that in lieu of actual practical thought process and trade ideas, right? So make sure that you're always giving thought to, what if I'm wrong? I think it's going to hold up here, but if I'm wrong, well, then this level matters. And what step am I going to take to fix that for me? Like, how am I going to get to a more comfortable situation? That's ultimately what we're looking for, everybody. Okay, moving off of the NASDAQ 100, let's look at the Russell 2000 off about 0.2%. It is leading us lower today, but again, a strong uptrend in here. 50-day moving average has been really good for the Russell since early April. Doesn't mean that that's going to stick, but that's what we're watching right now. We do still have higher lows. I love this test back here because this was matching lows originally, and then we rallied. Then we made a higher low right here, pretty close to the 50-period moving average. And then we made another one up here where we got below the 50-day for a couple of days, 2 out of 3 sessions below the 50-day, and then we were back up there. So we like what we're seeing out of the Russell. Obviously, yields are going to have some indication on this. This week, we heard of the Fed's increase to liquidity between going forward, basically to saying that they were going to be buying U.S. Treasuries to inject a little bit of liquidity to the market. We saw the yields drop on that notification yesterday, and they pulled back, and today we're getting a little bit of a bounce. But, ultimately, we have an uptrend in place. It's pretty obvious here, right? And the narrative around higher for longer rates continues to be kind of denied, at least by the price action we've seen in the Russell 2000. One of these is going to give way. Either yields are going to drop, allowing the continuation of the Russell 2000 uptrend, or yields are going to move through a level at which traders are no longer comfortable in small caps, at least not to the extent that we've been plowing in. So the fact is, right now, we don't necessarily know. Both yields are moving higher and the Russell 2000 moving higher. So we'll see. There's going to be a break point one place down the road. We just don't yet know where that's going to be. I think a lot of traders speculate that it might be as we approach the 5% level. But you know what? If I was going to throw a little bit of water on that, cold water on that idea, it might just be about 4.8. That's the highest we would have seen since back in April of last year. So you're looking at about an 18-month window. And of course, our high in the most recent period there was just shy of 5. But you know what? If we get over 4.8 and we make a higher high in the trend, well, then that's going to be a view for a lot of traders of, yeah, we're heading to 5. Right? And so with that in mind, if that's the view of the trader, the belief that we take out 4.8 and then suddenly we will be at 5%, well, then why would a trader sit on their hands at 4.8 and say, I don't need to take any action when the expectation is a greater likelihood of getting to that 5% level? They might start selling, we might start selling Russell and small caps broadly as a result. We'll have to monitor the price action there. So there's a quick look at your yields and your small caps. Let's go ahead and peek in on our semis, which are finally, holding serve a little bit here. I'm going to move off of that weekly back to my daily. And I say holding serve because we got beaten back at the 50-day this week. So we got up into the 50-day. We had that lovely tail through it, but we could not hold the 50 on the closing basis, and therefore we have been pushed lower. Now, as I'll zoom in here on the semi-index, you'll see that we are back to this gap area. And I'm going to put this as a rectangle, everybody. So here we had the move higher from 8.3 to 8.4, and this gap zone appears to be important for us, right? So we'll monitor this. We'd like to see that basically the lows we've established yesterday, today, maintain. We could get intra-period weakness down into that gap fill peak, essentially the highest high of the day prior to the gap. But this gap zone can be support for us. If it is in fact support, well, then we would say we've got higher lows at least, and we might be okay. And when I say might be okay, what I'm suggesting here is simply, yeah, we had this deep pullback, right? And percentage-wise, I'll just give you a number on that for fun. How about a 29% pullback from the peak to the trough? And then we've broken out of the channel, and while we haven't gotten back above the 50-day moving average, we have currently held this ledge after breaking the downtrend. So this is an important spot for the semis because any inability to maintain this gap level is going to make the 50-day become far more of a resistance point for us, and it might tell us that we are going to see a little bit more of a speedy trend move against one of those faster moving averages like the 20-day, for example. So I'll put up all the major ones here and notice where we are. We are kind of dancing at that 20 period, right? And so if we see a move lower through the gap zone, we are likely to witness the 20-day acting as resistance in the near term. That bears watching. Okay. Now, one final note. I don't like what we're getting out of the way of the RSI because our rallies into the mid-level, the 50 to 55 zone, is where we're losing our momentum steam. And what that suggests is bear regime relative to the trend. So the trend has weakened. The trend is not, as of yet, back in gear, so to speak, from a bullish standpoint. So we are at an inflection spot for the semis. Okay, so we're going to monitor that. Okay, now on today, essentially what I've noted is we've had a big, not a big, but a sufficient enough move in oil to give us a little bit of pressure, broadly speaking. So let's use some of these futures quotes. You all know that I'm going to use the /CL for the oil future, or for crude future, that is. Now, we're not advocating for futures trading. We're going to use this as an understanding of what oil is really doing, where we've been. You heard us yesterday, Brent and I, discussing oil and the current backwardation situation associated with the oil futures contracts. We'll just simply point this out for ourselves, not really going to, let's see here. That's right, that's right. I'm trying to see why I'm not getting all my futures symbols that go out a little further here. Oh, that's why, active only. Let's change that, drop down to all. There we go. All right, so when I change this to all, I should get the next few months of future symbols for crude, and then I'll open that up. All right, so there we go, everybody. You'll see when we say backwardation, we're trading on the current September contract at 88. To immediately here for the for this one, we're looking at October. Here, this is going to be tied to most active, by the way. So that's what's being quoted for us. But even at 86.5 versus January of next year, you're looking at a good 6%, $6 a barrel move. That's notable. So that's what we're referencing for backwardation, the trader's expectation of lower prices on oil. That stated, this does not look like lower prices for oil at the moment. We are at resistance of the downtrend line as we've been digesting the full reversal that we've undertaken, but ultimately each instance in which we've rallied into the downtrend line so far, these have been sell signals in oil. Now, we know that this is not necessarily going to hold. These sell signals are helpful previous, but what we're looking for is a rejection here, and there's certainly no guarantee. There's a lot of overhanging technical resistance here, but obviously it's all tied to headlines and it's all tied to the risk factors. And we've heard from the administration this morning, we saw there were some headlines from the president suggesting that he would impose a, quote, economic D-Day, end quote, on Iran, and that any country that helps them avoid sanctions would face severe financial penalties. And of course, these headlines sent crude higher. And so crude is pressuring things. Now we take that into account, and in conjunction with what we've gotten from the injection of liquidity from the Fed there, or from the Treasury, I should say, excuse me, then what we should also notice is the movement in the U.S. dollar. And the U.S. dollar has weakened substantially over the last 2 days. As you can see, we had been holding into an area that would have been considered support for a period here, right? I mean, actually, probably good to use a rectangle on this. So this looked like zone of support in here, and then with yesterday's news, we really collapsed and saw the US dollar moving lower aggressively. Now, you've got a doji so far, way too early in the day to validate any of that, so we won't. We'll see how this looks, but a lower dollar is positive for assets, and risk on assets you would have expected to maybe be a little bit more positive today, but I think what's happening is we're getting the immediate relief bounce to yields, and that relief bounce in yields on the heels of yesterday in combination with the move higher in oil is pressuring U.S. stocks. So even though the backdrop as it relates to the U.S. dollar is favorable for overall markets, equity markets that is, we're not seeing it play out on the equity side today. So we need to monitor the U.S. dollar. Again, lower dollar is good for our largest multinational companies. That's a good sign, at least from the equity side and the willingness to take on risk. Now, what is this U.S. dollar move doing to things like metals? We saw yesterday the move in gold was notable, and with the move lower in the dollar, we've seen gold kind of break a little bit higher. Now, it's not necessarily the view that that this is only to the upside, but you got to take into account the fact that we have broken that downtrend line. We do have the short-term trend, the 20-day orange moving average climbing upward through the 50. So we're seeing the indications of an improving shorter-term to intermediate-term chart. Now, could we be at a spot where we need a pause? Sure. We came off of the, we're going to call it 39.70 level and rallied up to 45.40 area here. So this has been a good pop. If we wanted to calculate it, we're not going to do the math. Let's just do the run. Let's 16% about this has been the move in gold. So look for the 20-day here, everybody. Again, the broken down trend can be managed thereafter with commonly with a moving average 20 period beneath us. For those of you looking a little bit more long or intermediate term, perhaps keep an eye on that 50 period. You'll notice that the 50-day is finally starting to slowly tick higher with the price action of the last 3+ weeks there. You see how that's already started to move. The 20 period clearly in gear already. So that might be good for some of you. And then maybe for those of you on an even faster time frame, you might like the 10-day. You'll notice that our last two sessions, today not included, the low of each were below the 10-day. But we quickly, yesterday, man, that was a great candle kind of validating it. So we'll see if that maintains. But I absolutely believe what all of you are talking about here is, the fact that the risk on with oil is a big deal. We're not likely to getting any true end to what's been going on. So at some point, I think the market's going to give in and no longer concern itself with the headlines and just start paying attention to really the chart. And again, here's the look at silver, everybody. The slight discrepancy here is that we're not above the 200-day where we're trying to stay above the 200-day on the gold chart. Again, futures symbols. Remember, you can trade futures at Schwab. We don't advocate for that, of course. But you do need to be approved before doing so in order to trade futures at Schwab. So we ask you to go through a couple of hoops to get that approval. If you're interested. But again, what we're most worried about here is just the trend. And this has been a very big unwind, everybody. As you can see, it was once again essentially a full round trip, right? We took out this area of resistance and then it was tested as support right here, came all the way back. So this is not as of yet, a brand new uptrend. I mean, it is off of the lows, not to the extent that we've seen with gold, but it is an improving look nonetheless. I say not the extent. It's actually a bigger percentage, but it's not above the 200 days. So the percentage move to the upside probably in the percentage pullback here has been bigger or deeper in silver than it had in gold. So I'm personally wondering if this is tied directly to just the applications, right? The gold being more or less luxury item and silver having practical commercial application that gold does not. All right, so let's see. We look at gold, we look at silver, we saw the dollar, we saw oil. While we're talking futures, let's talk about the one future that does seem to be moving here finally. And oddly enough, it's the most risky on asset perhaps, and that's Bitcoin. Finally moving a little bit, everybody. We got two consecutive big green candles have moved to highs that Bitcoin hasn't seen since early June. Obviously, as you can see, that 200 period moving average resides above us by about $4,300 or 4,300 per US dollars, I guess that would be at the 200-day. We'll see if that acts as resistance here, but there's a pretty notable downtrend line break, and I'll just point out, I'm going to draw in a downtrend line break if it's going to let me. Here we go. So I'm going to capture those peaks from early May. And so this gives the look of an improving chart, right? I'll remind you that one of my favorite go-to things that I hear Ben Watson, my buddy, say frequently when we're in these live events together is that, these upward moves get digested and pause. And what's going on commonly is that we're witnessing institutions moving dollars into these positions, but not wanting to do so at higher prices. And so what we'll frequently see are institutions moving in, letting price move, and then everything breathes. And then as everything breathes and pulls back to levels that they prefer, that's when institutions once again reassert their aggression and bring dollars back to bear in the trade. So remember, and this is one of the hardest things I think that we retail traders deal with, is we see two big beautiful candles like you had over the last 2 days in Bitcoin, and then what follows? Our impressions or our emotions that say, it's running, get in while you can. Those real active voice things that you get in your mind, those are probably the negatives we need to avoid, right? We need to be thoughtful and say, hey, in advance, I needed to be thinking about this back here. I want to buy Bitcoin. When will I look to buy Bitcoin? Well, when it takes out 67,200 approximately, then I'm going to be interested. But if you weren't thinking about it beforehand, and then today you look at it and say, look at those two big, beautiful candles. I hope that keeps running. I don't want to miss out. I'm going to buy. That's fine, but the risk is now on a pullback more so than a continued move to the upside. Try to tamp down those emotions a little bit. In fact, from my standpoint, my number one red flag for me is when my head starts telling me how great a job I'm doing. Instantly. Oh my goodness, why do I hear that? I need to move. Now I'm starting to get more defensive. And I learned a while ago that that was my number one red flag, is listening or reading my own press clippings. That's a terrible process for me. For some of you, that might be ideal. Okay, it might be good. But for me, it means that I'm believing in my process too much, and I am too willing to take on risk as a result. So I've got an emotional bias to that, and I want to tamp that down. I cannot maintain a successful approach if my emotions are overriding me. So that's what I'm trying to manage here. So try not to get too head over skis on any one move. The move in Bitcoin is good, but we do have plenty of overhanging resistance. Remember, our test of the 200-day, if and when it comes, is going to be our first test of the 200-day, and we will have been below it. Right now, we're below it for the last 9 months. Okay, and it's not uncommon at all for the first test of a major moving average as resistance to fail and need to make higher lows first. Saw a request in here. Let me get to it. Let me see. Where did it go? Copper. Yeah, Mighty Mouse. Let's take a look at copper real quick. Why not? Since we're talking futures symbols here, we'll look at HG. So, copper here, I think, is speaking right now, at least, to the most recent narrative around the jobs report. The jobs report kind of let us know that things weren't as rosy on jobs as we had been led to believe originally. So maybe that's why we're getting the breather, but also from a technical perspective, there's really been no breakdown here. The most significant move copper made was through this ledge of former resistance, now potential support. I drew in a deep cup and handle here to kind of give us an indication. I'm wondering what the depth of that move was. Let's see here. Just take my line, activate that most recent one, and let's see, where does that... Sorry, everybody. I'm still dealing with a little bit of lag on my end of things. I apologize. Okay, so I just want to get a little bit of a snapshot as to where this cup and handle move could be headed if the measured move target were to be achieved, which we all know is never a guarantee. So I'm just going to click and drag that line to here at the green level, and that'll give us an idea. So yeah, in the neighborhood of 7 is what we're looking at in terms of a potential measured move target. So, hey, we could very well see a bounce off the 50 period here, but that would be not out of the realm of possibility. That much is true. But in answer to your question, Mighty Mouse, I do think that the only reason is tied to that jobs number. That maybe, we've got a good bullish chart here for sure, but, we're just pulling back to an area of short run support, and it might be around that jobs narrative more so than anything else. So that's what we'll watch at least, but obviously more data that comes to the table will be helpful for us in understanding if that is in fact the case. Okay. Let's see. Yeah, I love that, K Brown. Don't confuse brains with a bull market. Man, do we all look and feel smart in a strong bull market? Yeah, we do. So right now, not necessarily an indication that, we're doing great. If you're doing great over the last 2 months, hey, that probably means you've got a pretty good handle on things, but don't take that to mean you've got it licked. The market will teach us lessons every chance it gets. Okay, so we've looked at a number of key areas. What do you say we dovetail? We were just talking Bitcoin, but let's move off of Bitcoin briefly and talk about some of those proxy individual positions that are moving as a result of this move in Bitcoin. So we saw Bitcoin above 70,000. So let me put this back up here and just give you a little more context here. Okay, so there's the Bitcoin futures once more. And let's put up all 3 moving averages. So that Treasury bond intervention that we talked about yesterday and a little bit today has kind of sparked this rally. Moved above 70,000 for the first time in more than a couple of months. Now the crypto assets have tended to rally when the U.S. authorities looked to boost markets liquidity. That's why we're seeing this little bit of a bounce here. Now, the companies that are commonly considered proxies for Bitcoin, we can look at Coinbase briefly and look at Strategy briefly. So both of these showing pretty clear levels of horizontal support, potentially an improving chart. But again, keep everything I mentioned about Bitcoin's chart and the fact that we're below the 200 period moving average so far, and the potential to rally into it as a possible resistance point. That's going to hold for Coinbase. And then Strategy is going to look something similar here, everyone, with a recent bottoming pattern, but finally back above that 50-day moving average. And thanks for your patience, everybody. Sorry about that little hiccup here on YouTube, but just simply speaking to the relationship between the Strategy shares and Coinbase shares as a direct link with the Bitcoin future. So please keep an eye on those two in particular. If you're watching Bitcoin, that is notable. Okay, how about some other individual stocks in the news? Now, let's look at the Moderna chart. We know yesterday we had big Moderna and Merck news. Moderna is breathing a little today. I mean, 18% down is never fun. However, I'll just mention 130, 140, 150% move in a single day. You're going to get take some of that move taken back. If there were ever a good reminder of why we try not to chase price, this is it. Somebody was a buyer yesterday in the neighborhood of 194.88. My hope is that they're no longer the holder there unless they're completely and totally comfortable with it and believe that there's more short-term upside and they can stick with it. But my goodness, moves like this to the upside commonly unwind in a similar fashion. Now, just for the heck of it, since we can do this, let's put a Fibonacci sequence on this and let's see what some would maybe call the line where we should see things hold up. Well, for a lot of traders, it's going to be that 50% ledge that comes in around 129, and then another layer beneath it at 161, or the 61.8%, excuse me, which is around 113.5. So that gives you a zone, and a lot of the times I'll do this as just a reminder of where I could fall, right? Because I could fall anywhere into that zone and find this to be support. Under 61.8%, it increases the likelihood that we find ourselves back where we began. And all I've done in this instance, everybody, is I've just drawn the low move to the high move. Basically, the price action right before the news hit and to the peak, it made sense. And that's all we're trying to calculate here. How much can we legitimately give back and keep this short-term uptrend running? This could be that level at 38.8 at the 38.2%. That's going to tell us, if it holds as support, that's going to tell us that that's a stronger move to the upside. That's a good thing. If it drops to the 50%, it's not a Fibonacci sequence number per se, but it is one that we often see provide support in rallies. So rally up, give back half, hold, and then can go back and continue the rally that it began. We'll see to what extent any of these levels maintain. Right now, we're sitting on today's pivot point. Remember, the pivot point is just taking into account yesterday's price action to validate today's price action. The equilibrium point is what the pivot is referred to as, the expectation of price, the majority of price action for a given day tied directly to the prior day price action. So, good move yesterday in Moderna, breathing a little bit today. Now, I saw today we had upgrade on Merck. In fact, it's a little, pardon the expression, a little murky because what we have today is an upgrade on Merck and then a downgrade on Merck. So let me give you this. First of all, we had that great move We've got a big gap zone to consider for potential support and trade management going forward. If we looked at this on a longer range chart, my goodness, everybody, this looks like a very lovely cup and handle, does it not? Breaking from a substantial cup. The majority handle, right, hanging out right here, right? Just like this. This would be the handle, and then we broke the highs on the cup right here, and the thing exploded. So we went from 132 to 153 real quickly. Now, if this is a breakout legitimately, then many traders are going to look at it like so. Then we'll put the depth of the cup as the potential target. Just the same thing we just did when we were looking at that other chart. And so I'll add that to the breakout spot. And that gives traders an estimated target here around 190. Now, as I mentioned, there's multiple tips here in news. So the first is the upgrade. So Merck was upgraded to overweight from equal weight at Morgan Stanley, upgrading to a new target at 179, up from 116. No guarantee to be achieved there either, whether that's the analyst target or our measured move target. And the recent success from the Merck pipeline cancer drugs leads the firm, Morgan Stanley, to raise their estimates. Morgan Stanley now projects a flat outer year revenue for the company through their Keytruda patent. And the firm adds that it projects a cash balance of about $80 billion for Merck in 2030, which can, of course, according to Morgan Stanley, support business development as well as mergers and acquisitions. Now, if I go a little lower, I'm going to find that both RBC exclusively RBC Capital downgraded Merck to a level at sector perform, previously had been at outperform. New target here is 150, up from 142. Merck's cancer vaccine data exceeded expectations as its strong momentum continues. However, RBC says that the 150 per share target that they trade at is an unprecedented valuation for a company facing significant loss of exclusivity in the next 2 years and then modest interim growth. So they're talking about things from a little bit more of a tamped down viewpoint on this news. So just keep that in mind. So a little bit of back and forth, tug of war there between Morgan Stanley and RBC at the moment. Let us see. I've got also an upgrade today on Progressive. Some of you had been watching me talk about Progressive recently. Let's put PGR in the chart. We know that financials as a collective have been a pretty solid sector. The interesting thing on this chart is the big move to the upside when we broke out of this downtrend. So I'll draw in the downtrend line here. In fact, this might be too slow. Let's go with a 2-year window on this for you. Here we go. Okay, so there's a short downtrend, right? But the ultimate peak was back here at around 290 a share. That's a really nice level. And we've been in a pretty healthy downtrend, right? I mean, our lows that we found in just this May indicate that we were off about 35%. Well, now that we've gotten off the mat, so to speak, as I zoom back in, notice that we came back, and this is what will happen commonly. I know we didn't see it in some of those other positions, everybody, but you break out, and then you need to get thrown back. And commonly, we think as traders, oh, we got to hold that 200-day. Otherwise, everything that happens afterwards is a mess and it's not guaranteed. You're right, it's not. But look at how well support at this 203 ledge has maintained. We've been there a number of times. Now, that doesn't mean it's going to hold, but it sure looks like we have tested and held it enough times to validate this as true horizontal support. Does that mean we can't revisit it? Unfortunately, no. We sure could see Progressive back there at that 200 level. But it is a nice bounce off of that spot. It does also lead me to wonder whether that's a Fibonacci sequence level. If anything, it's probably something like a 61.8% retracement spot off of the low to the peak, so the trough to the peak move. And this is actually a helpful reminder for some of you, is that, and when I draw Fibonacci's, remember, it doesn't tell us what's going to occur, but it can be the validation for what we believe is support or resistance. And so this could be confluence for us. So I'll draw it from the trough to the peak, and it actually looks like we're below it. So I can't even suggest necessarily that it's been important for us. It looks like the horizontal support here has little to do with the Fibonacci sequencing, perhaps, but I think I could state comfortably for a shorter term trader under 203, there's really not a lot of reason to be long the position in the short run here. The risk would be greater that you're revisiting 190 than you are going back higher if you trade under 203. So just keep that in mind. I think that's an important view there. All right, and then if I change this back to a weekly look, just for a little additional context, move off of this. Does offer a better view, doesn't it? This is a 5-year weekly, regardless of what my dialogue says here. But gang, that's the 200-week moving average. And so, look, if we're just traders in the longer haul who are more concerned with entrance on long-term trends rather than the noise of the broad market that we talk about 4 days a week here in Trader Talk, well, guess what? You have found a spot that has previously been a comfortable area for traders to participate. And we should not at all be shocked by what we've seen here. In fact, once more, I feel compelled to draw a Fibonacci move off of the true low way back here. This is going to be the 23 year. So remember how 2023 was a bit of a rough year for us collectively. Run that Fibonacci up to the peak at 293 approximately. Let's see where we get. Yeah, and so now, look at where we're basically at the 50% give back, and now we've held it. So, on the longer term view, traders can certainly set their risk against the 200-week simple moving average. Under that, it would be a very big development, everyone, because suddenly we're looking at a 15-year weekly chart, and we have been above the 200-week moving average in Progressive for a very, very long window of time there. Does that mean it has to stick? Of course not. But it is a good view of where traders would look to expose some money to such a position over a longer term time horizon. All right, I see one other request, and it's on Walmart, and we know we heard from Walmart, so let's take a look at Walmart in our final notes of the day. It looks like I've got some lines drawn in here. All right, let's just clean it all up because none of that seems to have held. So we're going with our 2-year chart. Let's back this off. Where do we find ourselves, everybody? It looks like a breakdown, doesn't it? And yet, at one point, our highs, our resistance, can become support. So I'm going to flatten this out so that it is perfectly level, and we're basically at former resistance, now potential support. Does not look great for Walmart here. Now let me see if I've got the specifics on the details out. I don't think I have the notes, everybody. So let's take a look at our news detail over here. So Walmart down 8%. Now we're down 8 3/4. Okay, so the headline here of note, everybody, is that sales growth in Walmart hit the weakest level since 2020. Pharmacy dragging Walmart down specifically. That's the takeaway here. Not a lot of great things on the chart unless we found ourselves again considering a longer term viewpoint, everybody. Let's back this off real briefly. That candle looks terrible. That is not a bullish candle. And because it is so significant at that 50-week moving average, traders are perhaps building cash given the move. So certainly understandable. This is not great. Could this be support? Potentially, but let's not start grasping at straws. Allow prices to dictate when you decide to step in. If you're looking for any kind of confirmation of support, some would consider the 100-week moving average to be that. Going back all the way to March of 23, we've seen Walmart maintain that level. So certainly want to see this level around 100 to 105 provides support, but we do need some time on the chart, and you got to give it to the stock. And when we're looking at the ultimate peak up here, the range was 135 on the high side, and then the downside was 118, so about a 17-point move, and that gives you right around 100, excuse me. So breaking the range from the peak to the bottom, and the same range to the downside from 117 down 17 points will give you about $100 a share. So that's an approximate measured move, and we may very well be close to that. So unfortunately, we are at time, everybody. I hope today's session was helpful. We got to a number of details for you today, both macro and micro level. If you liked today's conversation, help me out with a thumbs up down below. We're going to get this reviewed and into the archive for you here shortly thereafter. And of course, we've got plenty more to come for you on the channel. Make sure you're subscribed. Follow me on X, Kevin Horner CS. Be on the lookout for posts from me throughout the week. Commonly, a lot of charts is what I try to bring you, everybody. So with that, have a great rest of your Thursday, everyone. We look forward to catching up with you all again real soon.